Hi everyone, it's Amy Salera with Keller Williams Real Estate in Pittsburgh. Today I am joined by Kevin O'Loughlin, who is a mortgage loan officer with Movement Mortgage, also in Pittsburgh.
Hey guys, how you doing?
And I asked Kevin to jump on this call with me and do a question and answer session because I know I'm frequently asked about the mortgage market and interest rates, and Kevin has been putting out such valuable, informative content on his Facebook page. So I asked him to jump on here with me today and share some of his knowledge and hopefully provide you guys who are watching with some value as well. So Kevin, thank you so much.
Yeah, thanks for having me on. First thing I gotta say, just nobody judge the hat, my hair. You don't want to see my hair right now. The quarantine has gotten the best of me. But thanks for having me on, Amy. Hopefully we can answer some questions and give some good value today.
Yeah, I'm normally wearing my hair in a ponytail because none of us are getting our hair cut. So we're all in the same boat. So before we get started with the questions, do you want to just give everyone an overview and an introduction of who you are?
Sure. So my name's Kevin O'Loughlin. I work here with Movement Mortgage, and I've been in the mortgage space for going on my fourth year now. And I've been in financial services. I worked at a bank and auto loans actually before I got in the mortgage for about 4 years, 4 years as well. So kind of been in the lending space which is crazy to me, almost 6-7 years now. I moved to Pittsburgh about 3-4 years ago and kind of planted the flag for Movement Mortgage, and just really love the lending space and love helping people get into homes and really just trying to add value. Add value as much as you can to people, and that's kind of my motto. So I'm originally from Buffalo, New York. I love the Buffalo Bills, so Steelers are my number 2. Love my chicken wings, but I live a pretty simple life. Work a lot, do the mortgages and everything like that, and just trying to help as many people as possible. So that's my elevator version of my bio there.
Perfect, thank you. So let's jump into the questions then.
For sure.
So one of the questions that people are always asking is what's going on with interest rates. So can you give us a little overview of where interest rates were prior to COVID-19 and the quarantine, and then what's going on now?
For sure. So just for people that don't know exactly how kind of mortgage interest rates work. So mortgage interest rates fluctuate with the stock market, and COVID has kind of caused, a lot of volatility in the stock market. And it's not always directly correlated with COVID. There's other, factors that cause the stock market to go up and down. But kind of as the stock market is plummeting, that has a relationship with mortgage rates. And as the stock market kind of goes down, and you still got me?
Yeah, you're back. Were you getting a phone call?
Yeah, I put my phone on do not disturb too, so I don't know why that happened.
That's okay, you're back.
So as the stock market kind of goes down, mortgage rates go down as well. So pre-COVID, rates were pretty good on a 30-year, probably mid to high 3% range, which is still like 20-year, 10-year lows, still in a very great position. But once COVID hit, we actually saw the stock market kind of crash a little bit because investors were fleeing from equities and risky stocks and fleeing towards the bond market, which is viewed as a safer investment. That kind of move in the stock market pushed mortgage rates even lower. So rates right now, as of today's May 7th, the 30-year mortgage is averaged at about 3.25% right now, which is incredible. And it's kind of crazy. So refinance applications are booming right now. So lenders there's just so many changes happening, and a lot of lenders can't even handle the volume that's coming in. So some lenders have started to raise rates back up, even though the stock market has fallen, because there's so much demand for refinances and they can't handle it all. So it still is a great time to refinance. Rates are at about 10-20-year low right now, and I do believe they'll stay low for a while.
And that was going to be, you kind of led into the next question is this a good time to refinance, and how would someone know that they might be a good candidate for doing so?
Right. So the first question that we ask everyone when they're considering a refinance is, how long do you think you're going to be in the home for? That is the most critical question to know. And if you're going to be in your home less than 3 years, less than 2 years, it's not going to make sense most likely to refinance, just because there's a cost to refinance. Refinancing is not free, and there's a cost associated with that. So it typically takes about 2 to 3 years to break even on the cost of refinancing for the savings that you'll get from the interest rate being lower. So first question is, how long will you be there? And then the second thing is, my team, what we'll do is kind of prepare a break-even analysis and show you, hey, over 10 years, 15 years, 20 years, here's how much you'll save. What we find is kind of a rule of thumb is, if you're in the high 3% range or a high 4% range or even low 4% range, it makes a lot of sense to refi, because if you can get your interest rate down a point, I mean, that is a big finance charge amount over, say, 5, 10, 15, 20 years.
So let's move on to forbearance and deferment, because I know these are hot topics right now. And, I know there's a lot of job uncertainty, and even for people who might have been able to pay their mortgage payments as planned, they might in the future not be able to. So first of all, what's the difference between forbearance and deferment? Because I hear them used interchangeably.
Sure. So forbearance is, from what I've seen so far, is really mainly correlated with the mortgage, where deferment is more so used for like student loans, like you can defer out your student loans. But for what's going on with forbearance and mortgages right now is, essentially, it's an option to where you can delay payment. There's a couple risks involved with this. So when you put something into forbearance, your mortgage, it's not actually going to be a negative mark on your credit. So it's not like your credit is immediately going to go down 50 points. But what people are missing right now, and this is the biggest concern, is it's still pretty new. It's still such a new thing. And as far as what we've heard right now, Fannie and Freddie, who basically are the ones that make the guidelines that we have to follow as lenders for conventional loans, there isn't too much new guidelines surrounding this. So right now, it seems as though if you enter into a forbearance, most lenders are going to treat that as you didn't make your payment. So while it may not hurt your credit score, it's going to hurt you potentially when applying for your next loan. So say if you're a seller right now, right? And you got your home on the market, you were pre-approved 2 months ago to purchase your next home, and you're just waiting to get your home sold. And you find out about this forbearance thing, and you're like, oh, this is great. I can get 3 months off my mortgage. It sounds great, but if I'm a seller right now with the uncertainty surrounding this, I would not enter into forbearance if you plan on buying a home within the next 6 to 12 months, because it most likely will hurt your eligibility in qualifying for that next loan. Once again, entering into forbearance is not going to immediately damage your credit. It's going to affect you on that next loan that you take out.
And is it true that if you go into forbearance for 3 months, come the 5th month, all of the payments need to be made whole, or are they tacked on to the end of the loan?
That's a good question. And so it's all up to the servicers of the loan. So every servicer is going to have a little bit of different guidelines on what they're going to allow for forbearance. Some may say, hey, we'll give you 3 months off, but on the 4th or 5th month, you got to pay it all. Or some will say, hey, we can push this out, 2 years for you and then pay it then. Or they'll do a balloon payment at the end of the loan. There's a lot of different options surrounding it. There isn't just like one clear cut, because every servicer is going to handle it a little bit different.
Okay, so if you're thinking about filing for forbearance, obviously you have to ask that question, like, when is this money going to be due? Is there anything else that you should ask your servicer before you jump into this decision?
I would just get all the clear repayment outlines in writing, because the sad, ugly truth of this thing is these servicers, I mean, they can't even handle the requests that are coming in. So if you try to call a mortgage servicer right now, you might be on hold for like 3 days. I mean,
Okay.
that's how much volume is coming in on these forbearance options. So, and I mean, I'm always a worst case type of thinker, but who knows? You're talking to a customer service rep. They could be on their second day on the job, right? And not clearly understand and then tell you something verbally that may not even be accurate. So I think my biggest tip, if you're considering forbearance, make sure you have a written agreement and don't just go off of what that customer service rep is saying on that phone verbally.
Okay, that's a good point. Get it in writing.
Yeah.
How have you seen lending standards change, if at all?
No, really good question. And there's changes every single day right now in this current lending climate. So basically, like you said, what has happened is the servicers and the buyers of these mortgage-backed securities who are buying up the servicing rights, we used to at Movement Mortgage, we typically sell most of our loans, meaning we are not collecting payment or servicing them. And we used to probably have about 5 to 6 servicers of government loans, meaning FHA, VA, USDA loans like that. And practically overnight, it got cut severely. So there's maybe, 2 people out there right now that are still buying government loans. And the reason they kind of left is because the risks that are involved. So like the government loans are typically the lower, credit score. Investors want safer paper, essentially. They don't want the heavy risk in a market like this. So as soon as all this stuff happened in the financial markets, lending saw huge changes overnight. So there used to be a ton of products called non-QM mortgages, which are essentially non-Fannie or Freddie mortgages, which essentially are private investors that can offer, bank statement loans. They can offer foreign national loans. They can offer the really outside of the box programs. A couple of those companies a couple went bankrupt. A couple just left because the investors that were backing those companies no longer wanted to take the risk of those loans because they have such a high percentage of default. So the non-QM market basically disappeared overnight a couple weeks ago. And then also a couple of changes we saw is the jumbo loans. The jumbo loan market is another high risk mortgage that tightened up, and a lot of players jumped out of jumbo overnight. Wells Fargo, for example, would allow basically any lender like Movement Mortgage or any lender in the country allow us to send, loans through Wells Fargo to do jumbo loans. Wells Fargo said, hey, we cut off all correspondent lending. Movement, you can no longer send us loans. The only people that can do jumbo lending is at Wells Fargo. So that created a crazy situation. And Wells Fargo tightened up their standards on jumbo lending to say, hey, if you don't have 20% down, if you don't have this, this, and this, we don't even want to look at you. So everything just kind of tightened up immensely. Same thing happened with government lending. So a lot of lenders typically could go down to 550, 580 credit scores. And now some lenders don't want to look at anything under 680. And if you don't have 20% down, they say, go look someplace else. So basically there's just, everyone didn't want the risky loans anymore. Everyone wanted to move to the safe, conventional, 700 plus credit score, 20% down type of products.
So if you had a magical crystal ball and could look into the future, I'm sure you get this question all the time, but what are you seeing or hearing or people are predicting are going to happen with interest rates later in the year, in the future, after we're out of quarantine? Do we think they're going to stay low or rise?
That's a really good question. And if I had to answer that question, I'd be making like 10 million a year on Wall Street because I'd be buying futures and options and everything. But just based on some of the data and just what we're seeing out there, Barry Habib, who's one of the best people at predicting the mortgage interest rate market, has been quoted saying that he does see the 30-year mortgage dipping under 3% in the near future. I don't know if it will happen. Once again, that's a prediction. But I think from what I see from most people is up until the election, mortgage rates should stay pretty low. And then after the election, obviously they do have the ability to increase, but we should be safe for another, 5-6 months with low interest rates, which as soon as this COVID stuff comes up, I really do expect to see a boom, especially in the Pittsburgh market. I mean, it's going to be a great time to buy just because rates are so low. And I expect a lot of listings to come on the market as well. Just with no one wants to list right now until COVID is up. So it should be a great time, to refi and buy, for the next couple months. And I really urge people to take advantage of this while rates still are low.
And this wasn't on my list of questions or comments that I originally gave you, but it's along the same lines. So, just so everyone is aware, and correct me if my numbers are wrong, but like, even though we talk about rates are low and they're jumping up to like 3.5 or high threes, like historically, this is the ultimate low still, right?
Right. No, that's a really good point. So I don't know the exact stat, but if I had to guess, the average of rates over the last 20 years, probably in the neighborhood of 6, 7, 8% on a 30-year mortgage, roughly. Don't quote me on that, but somewhere in there. So it's funny. So I work with a ton of millennial buyers. I work with a ton of just people in general. And it's just funny when I'm talking to most millennial buyers, they'll, like, I've had some of them complain about 4% rates or high 3% rates. And it's just a lot of us, I'm a millennial, so I can't, can't judge here, but I think a lot of us millennials have not seen a market with high rates yet. So we've been spoiled a little bit. So, I mean, if you can get a mortgage realistically under 4.5%, I mean, that's phenomenal. That is on a 30-year mortgage. Like I sometimes I think to myself, like, okay, if I'm giving my money to somebody on a 30-year repayment on a home, would I be okay with, charging them 3.5%? Like, no, like absolutely not. So the banks aren't making that much money at these historically low rates. And it's funny. I remember my dad, he had a couple mortgages, and he always tells me, he's like, man, I got excited when I refinanced from 9% to 7.5%, and I paid 2 points to do it. So the answer is yes. I mean, we're at all-time lows, whether you're buying or purchasing. I mean, it is a phenomenal time, and hopefully they stay low as long as possible. But realistically, I do think within the next, 12 to 24 months from now, we're going to be in a 4, 5+% interest rate market. They can't stay this low forever.
Yeah. Anything else that I didn't ask you that's worth mentioning?
I think the biggest thing, if you're a buyer out there listening and you're contemplating a refinance, is just get the numbers, take a look at it. If you have a mortgage right now and you don't look at refinancing, you're absolutely crazy. I mean, definitely do it. Now's the time. And if you're a buyer out there listening and you're potentially looking to purchase, now's a great time as well. I mean, with the rates where they're at, it's great to lock in a 30-year mortgage right now. And Pittsburgh is a great market. When you purchase that home, it will appreciate. It's historically about a 3% rate. And right now, if you're a seller, I think the biggest tip that we talked about today is, man, only enter forbearance if you absolutely need it. I mean, I guess if you're not going anywhere for 10 years, like a forbearance isn't going to hurt you. So maybe it makes more sense in that regard. But if you're a seller and you plan on purchasing a new home in the upcoming future, like, talk to a lender, get pre-approved and talk to them about the effect of that forbearance on your next loan. And that's just a message to all real estate agents out there that are listening. If you have a listing, check in with your seller and make sure they have an up-to-date pre-approval, and ask them if they're in forbearance. Because say, for example, you sell their home, get it under contract. You go to put them under on the next home, and then they go through underwriting and get denied because we didn't know that they were in forbearance.
Okay, perfect. Thank you so much. If people have additional questions or want to reach out to you further, how can people get a hold of you?
For sure. So my cell phone number is 412-600-1527. You can call or text me anytime. And you can also email me. My email is kevin.o'loughlin, which is OLAUGHLIN @movement.com.
Or reach out to me and I'll put you in touch with Kevin too. I have his contact information. So thank you again, Kevin. I really appreciate it. And we will talk to you again soon.
Awesome. Thanks so much, Amy.
Thank you.